Hello, Matthew Bell with InsurancePrescription.com. Today I want to talk a little bit about Roth conversions. So a Roth is a kind of individual retirement account or individual retirement annuity, an IRA. In general, IRAs are personal retirement savings vehicles that have certain tax benefits to them and long-term growth potential. There are two sorts. There is the traditional IRA and the Roth IRA. I go into greater detail in these in other videos, so I don't want to entirely repeat all of the ins and outs of Roth IRAs and traditional IRAs, at least not contributory IRAs. Contributory IRAs would be ones that you open and you pay a little bit toward every year. Contributory IRAs have various income and contribution limitations. In 2020, as with 2019, the contribution limits on both contributory traditional IRAs and Roth IRAs were $6,000 if you were younger than 50 years old, and an additional $1,000 was allowed if you were over 50, bringing your total amount that you could contribute to $7,000. Now, even though I don't want to have to retread a lot of ground, it is going to be important in talking about Roth conversions that you have some basic grasp of the difference between a traditional IRA and a Roth IRA. So there are a number of niceties I'm going to ignore here, but I at least am going to sketch the basic contours of the difference between a traditional IRA and a Roth IRA. In general, a traditional IRA is at least in principle tax deductible from the standpoint of contributions. So you contribute to a traditional IRA, you get a deduction on the contribution. Your earnings grow tax deferred, and then distributions that you take are taxed. Now, there can be a penalty that's assessed if you are younger than 59 and a half, unless certain caveat situations occur. So once you're 59 and a half, you may start to take penalty-free distributions from a traditional IRA, but you're going to pay tax. You're going to pay tax on the contribution and on the earnings. A Roth IRA is going to be different. So you do not get a tax break on the contributions to a Roth. You pay tax on the contributions to a Roth. It also grows tax deferred, but then with the Roth IRA, you actually get a income tax-free distribution provided, provided that certain qualifications are met. So for instance, you have to be at least 59 and a half years old, and the Roth actually has to be open for at least 5 years. Once again, I'm painting with a very broad brush. There are a number of things that could be said. I say some of them in other videos, and I don't want to repeat them here in the interest of time. Now, these accounts are useful because tax deferral is an attractive thing. It enables you to have your money grow faster than the money would grow if it were subject to income tax on a yearly basis. So, for instance, if you were taxed as interest is credited or as earnings accrue, as you might be, for example, in a non-qualified certificate of deposit, when you're just 1099 on the thing every year, then your money doesn't quite grow as fast as it would if you had access to a tax-deferred vehicle. But for a couple of reasons that we'll kind of touch on at the end of the video, sometimes it is advantageous to be able to convert from a traditional IRA into a Roth IRA. And when this occurs, it's essentially going to be turning the traditional IRA funds into funds that are going to be handled like a Roth. So if you want to think about it like turning a traditional IRA into a Roth IRA, that's one way of thinking about it, and that transformation is called a Roth conversion. The conversion process essentially consists of taking a distribution from your traditional IRA, a distribution that is subject to income tax. You pay the income tax, and then you make a deposit into your Roth IRA. So you're essentially withdrawing money from the traditional IRA, settling up the tax on it, and then putting it into your Roth. So taxes on the IRA are payable at the time that you perform this conversion. Now, there's no age restrictions in the sense that if you're old enough to have a Roth IRA, then you're old enough to convert a traditional IRA. There's no age limitations in the sense that you could be 80 years old and still perform a Roth conversion if you thought that it was going to be beneficial to you. So if you're younger than 59 and a half, there's no 10% withdrawal penalty for performing the Roth conversion. So as we said previously, if you're younger than 59 and a half and you took a normal distribution from your traditional IRA, you would be subject to a 10% penalty in many cases. But in the case of a Roth conversion, the distribution that constitutes the conversion isn't subject to the same 10% penalty. Now, having said that, once you have funds in the Roth, let's say they start earning money, if you withdraw funds within 5 years, you can be subject to the 10% penalty in that case. Now, having said that, you can access the contributions and converted funds in a Roth IRA at any time, and you don't have limitations in terms of that. You wouldn't pay income tax on the money that you've put into a Roth because you've already been taxed on it. So distributions from a Roth are subject to an IRS ordering rule, which basically states that contributions come out first, converted money comes out second, and earnings come out third. So the instrument is what's called first in, first out, or FIFO. Essentially, the non-taxable money is exhausted first before any of the money subject to taxation is taken out. Now, why would you want to do a Roth conversion? So it can be part of a retirement planning strategy, and in particular, if you think your tax situation is going to be worse down the road, a Roth conversion can be a very attractive thing to do. So Roths would be favorable if a couple of things are the case. So number one, a Roth might be more favorable than a traditional IRA if, number one, you're in a low tax bracket now and you expect to be in a higher tax bracket later on. Now, for many people, this isn't the usual circumstance for retirement. In usual terms, a person is going to take a pay cut in retirement. At least that's the way most retirement planning strategies, what they assume. You're going to take a pay cut, so you're going to be in a lower tax bracket. But if for some reason you think you're going to be in a higher tax bracket later on, particularly in retirement, then a Roth IRA might be an attractive vehicle for you. But the second reason a Roth IRA might be attractive is, apart from the question of what tax bracket you're in, there's the question of what actual tax rate is applied to that bracket. So whatever tax bracket you're in, the rates are not set on that bracket for all time. The Congress changes those periodically, and the tax rates can go up or down. So regardless of your bracket, if you think your effective tax rate is going to be higher in the future, you might also consider doing a Roth conversion. And I'll tack on just one more. If you're not sure whether or not your tax bracket or your effective tax rate is going to go up or down, then you might consider a strategy in which you diversify your tax liability. In other words, if you are putting everything in a traditional IRA or in a 401k, then you are practically speaking betting that your tax situation is going to be better down the road, and maybe it will be. But if you're unsure, you might also consider doing a Roth conversion on at least part of your money, because that is at least going to spread your tax liability around so that you have some of it in a vehicle that's subject to taxation later, and some of it you've settled up taxes on now. Another reason that you might consider doing a Roth conversion, or another reason people find it attractive, is that you can reduce the amount of money that is susceptible to a required minimum distribution. Of course, this is simply another way of putting the fact that you're taking money out of a traditional IRA or out of a 401k. So the 401k and the traditional IRA are both subject to required minimum distributions. I've gotten into these in other places, although some of the information needs to be updated now that the Secure Act has been passed. Most strikingly, the required minimum distribution beginning date used to be at age 70 and a half, and now it's age 72. However, if Roth conversions are attractive, one of the reasons they are is because it reduces the amount of money that's in a traditional IRA or a 401k, which reduces the amount of money that a person is going to have to take out in terms of required minimum distributions. Now, whether that's a good thing or a bad thing, it's going to depend on your situation, whether it's attractive or not. A third reason a person might consider a Roth conversion is if they plan on leaving money in a retirement vehicle as a legacy piece. So if they want it to go to their heirs, they want it to go to sons, daughters, grandchildren, whatever. Well, in the case of a Roth conversion, you would essentially be prepaying tax that otherwise your heirs would have to pay on money that was inherited in a traditional IRA. So you're gifting them, essentially, if you want to think of it that way, you're gifting them the gift of prepaying certain tax. And this kind of a gift is not technically a gift, so it's not actually reported on an IRS gift return. A couple of final points here. So first of all, one question is, can you do a Roth conversion from an employer-sponsored plan? We've talked about traditional IRAs. And the answer is usually yes. In fact, the IRS provides that you can actually do an in-plan Roth conversion. Why that might be attractive is in some cases you might have other restrictions on accessing money in an employer-sponsored plan beyond simply attaining the age of 59 and a half. And so the IRS provides that you can actually perform a Roth conversion inside of your retirement plan. Now, there is obviously a caveat there, and that is that your employer-sponsored plan has to allow for this, has to have the ability to provide you with an in-plan Roth or Roth conversion, and not all plans do. But if you have that ability, generally that's going to range over any elective deferrals, any money you've put in, and any employer-matched money that you're vested in. However, even if your plan does not allow for an in-plan Roth conversion, you may find that you're still able to roll over some money out of the 401k or other employer plan, put that money into a traditional IRA, and then do a Roth conversion on the traditional IRA in the usual way. So for instance, in some cases, you might be able to perform a rollover of your employer-sponsored funds into a traditional IRA and then do the Roth conversion on the IRA as a second step. So generally, and this isn't a place to discuss rollovers, but generally a rollover is going to be a transfer of funds from one retirement account to another retirement account where it's not considered a taxable event. So the rollover would be step one, and the Roth conversion would be step two. So in particular, if you do a trustee-to-trustee transfer, which is a way of moving funds, let's say, from an employer-sponsored plan into a traditional IRA, that wouldn't be a taxable event, and then you would put it into a traditional IRA where then that traditional IRA has the ability to be Roth converted. One final point, sometimes you might hear about something called a backdoor Roth. A backdoor Roth is really not any separate type of retirement vehicle. It's simply another way of referring to a Roth conversion. So it's usually referring to an IRA that's been converted into a Roth. Now, in context, it's not referred to generally as a backdoor Roth in every context. Usually, a backdoor Roth comes into the conversation when a person exceeds the income limitations to be able to open a contributory Roth. There are income limitations to being able to start a contributory Roth. So if you make too much money, whether single, married, filing jointly, there are different levels of income that are allowed depending on your filing status. But if you make over that amount, you may not be able to start a contributory Roth. And so one way of getting around that legally is to start a traditional IRA and then convert it into a Roth later. So when that is done for the purpose of getting a Roth when you otherwise wouldn't be able to because you've exceeded the income limits, generally in that context it's sometimes referred to as a backdoor Roth. But again, it's not a separate retirement vehicle. So in summary, converting a traditional IRA into a Roth IRA is essentially just creating a taxable distribution from your IRA and then depositing the funds into your Roth after you've paid the tax on them. The idea is you're looking to settle up taxes now, you're looking to pay taxes now in order to get a future tax benefit. As with a contributory Roth, you have to be at least 59 and a half in order to take advantage of the tax benefits of the Roth, and the Roth has to be open for 5 years in order to start drawing on the earnings without having to pay tax, or if you're younger than 59, without incurring a penalty. You should also be mindful that the 5-year clock starts for every Roth conversion. So for every Roth conversion you perform, there's a 5-year waiting period on earnings for that particular conversion. And don't forget, I also have content that specifically focuses on the Roth, on the traditional IRA, and in those videos I get more into the income limitations that I simply am not going to get into here for the sake of time. If you found something of use in this video, I invite you to like it, subscribe to the channel, click the notification bell to be alerted to new content as it becomes available. I thank you so much for being with me today, and I look forward to seeing you again in another video.